Hey everyone, Kevin here. What do you think happens to real estate in a recession? And do you think there's any difference between small real estate, like houses or duplexes, and really big apartment buildings, like the big boy kind of stuff? Well, yeah, I mean, a lot of us usually think, well, okay, let's think about this logically. You know, we're all logical people, so let's think about this. Okay, recession happens, people are likely to lose their jobs. That makes sense. Recession, people lose their jobs, okay. And then those people might have to sell their houses if they own one, and then they become tenants, which means there'll probably be more tenants, which means they'd probably go rent from apartment buildings, which means rents will go up at apartment buildings and prices will go up at apartment buildings. So apartment buildings are where it's at for investing in real estate. Yeah. Well, what if I told you Harvard found that was totally wrong? Well, you might be surprised, and so was I. I was so surprised that, well, I wanted to share it with you. Now, to make this as simple as possible, I'm gonna include little footnotes here at the bottom of the screen, just so you could see which section of the study I'm referencing. And if you wanna see a copy of the study that I've annotated, just click the link in the description down below, right under where you can take advantage of joining me in my real estate courses or courses on money and property management, and join me for my daily live streams at 9 a.m. every day. All right, so what was the difference? What happened between single family real estate and multifamily real estate? And this is really where things get shocking. First of all, Harvard actually found that there was more speculation in multifamily real estate leading up to the crash, which speculation is bad. Speculation means you have people going into deals not caring about how much they're paying. They just want to park money. When you hear people say, I just want to park money and I don't mind paying $100 million for that apartment deal because I'm going to sell it to some idiot who's going to pay me $120 million for it. $20 million profit for me. When you hear people saying that, you're listening to a perfect example of something called the greater fool than I theory. If you haven't heard of that theory before, it basically says, hey, you know what? I'm going to buy this and there'll always be a greater fool than I who will pay more money for me. And that's really bad. And Harvard found that there was actually more of this kind of speculation in multifamily real estate over single family real estate, which doesn't end too well for multifamily real estate. Despite us going into this thinking that, wait a minute, more people should be wanting multifamily real estate during a recession. Yeah, wait for that one. Unfortunately, because there was so much speculation before the crash, big investment companies had to get more creative, and they started getting interest-only loans and shorter-term, riskier debt that came with things called balloon payments. Balloon payments basically mean, hey, when 7 or 10 years go by, the bank calls you up and say, you owe us all the money. Well, that's really bad if you owe us all the money during a recession. And that's exactly what ended up taking down a lot of real estate investments in the bigger multifamily space. Don't get me wrong, there was plenty of speculation in single family. Dead people were getting loans, teachers were getting mansions, okay? It was bad. But a lot of these investment companies were taking out shorter term debt or interest only debt where they're not even paying down the loan because they wanted to be able to tell their investors, hey, look, you're getting bigger dividends, you're getting more cash flow. But they weren't actually getting better deals. They weren't actually running the properties better. They were just getting crappier and riskier forms of financing to compensate for the fact that the deals were crappier. And on top of that, before the crash, bigger multifamily investment companies started looking in areas outside of their expertise and started investing in areas just to try to find more cash flow, when in reality, they were investing in areas with riskier tenants. This is what Harvard found. When it came time for the crash, a couple of interesting things happened. First of all, tenants ended up suffering a lot more of what's called a rent burden. This is kind of like if you get paid $2,000 a month and your rent's $500, your rent burden is about 25%, right? 25% of your pay goes to your rent. Well, what if your hours now get cut and you're only making $1,000 and your rent's $500, your burden just went up to 50%. Well, during the crash, Harvard found that a lot of tenants' rent burden went sky high as their hours or jobs got cut back. And this disproportionately affected very low income or low income tenants, specifically in multifamily real estate. As more tenants got stressed out during the recession and either had to leave or get evicted, operating costs for big multifamily apartment buildings went up as evictions went up, maintenance went up, and other unexpected costs all went up at the same time. So all of a sudden, there was less rent coming in, expenses were going up, and landlords were really starting to suffer. At the same time, the clock was ticking on shorter term, riskier debt. And this is where three really big and shocking things ended up happening to multifamily real estate compared to single family real estate, which I have to say blew my mind. But here's the data. Vacancy rates, or the percentage of units that are vacant or not paying rent, went up substantially higher in multifamily real estate over single family real estate or smaller deal real estate like duplexes, triplexes, and fourplexes, because Harvard found that people preferred renting single family properties. This was at the same time as less big multifamily buildings were being constructed, which means you actually had less supply, but ironically, the opposite happened. Less supply, the market's crashing, and vacancy rates in multifamily are going up higher, worse than in single family real estate. This is Harvard's conclusion, not mine. In fact, vacancy rates got so bad that in 2009, vacancy rates for multifamily real estate jumped to the highest level ever recorded in the 50 years data was recorded on multifamily real estate vacancy rates. Obviously, vacancy rates went up for single family and small deals as well, but I thought it was ironic that multifamily real estate would have a higher vacancy rate than these other forms of investments. It's kind of the opposite of what we would think would happen. This impact, by the way, was even more prominent in areas that were considered overbuilt, like Dayton, Ohio, Phoenix, Arizona, Memphis, Tennessee, and Orlando, compared to areas that were underbuilt like Sacramento, Indianapolis, or Grand Rapids. By the way, quick shout out to Benjamin, who purchased his first property in a desirable neighborhood in his area at a wedge deal. Benjamin is in my real estate investing group and do-it-yourself property management group and says the courses are well worth the money. Just do it and you'll thank yourself later. Thanks, Benjamin. On top of substantially higher vacancy rates, real estate rents for multifamily real estate dropped 4.1% in just 1 year from 2008 to 2009, especially as larger multifamily real estate started offering more concessions like your first month free if you move in with us, just to try to compete with the single family and small deal landlords. Well, now guess what happened? Vacancy rates up, more evictions, more problems, rent is going down, operating expenses are going up, so all of the costs are higher, the income's lower. Guess what ended up happening to multifamily property values, despite our assumption that multifamily real estate would do better than small deal real estate in a recession? Property values in multifamily real estate plunged. In fact, they ended up falling more than single family real estate home values fell. Let's do the math. Harvard found that if you invested $100,000 into multifamily real estate, your $100K would be worth $195,000 at the peak, which is really good. Unfortunately, during the crash, multifamily real estate lost 40% of its value throughout the country, which meant that $195,000 went down to about $117,000. On the flip side, had you invested that $100,000 into single family or small deal real estate, your $100,000 would have grown to $176,000, which is less than the multifamily real estate, probably because of all of the rampant speculation and overpaying and risky loans. But single family or small deal real estate only ended up falling 32% in value, which would have left you with about $119,680. Now, obviously, that's pretty close. You could almost say multifamily real estate and single family real estate are basically on roughly the same market cycle. But it totally kills the belief we had at the beginning of this video. And that's the crazy thing. At the beginning of the video, we said recession, more tenants, more people are gonna rent multifamily. But Harvard found the exact opposite happened. Less people chose to rent multifamily. Multifamily ended up having more management nightmares and ended up falling in property value more than small scale real estate. That was mind-blowing for me. And so that really got me thinking about my real estate investing strategy. I've always been tempted to invest in different areas, maybe where there's more cash flow because I'm in Southern California and here I am doing really well investing in wedge deals, buying houses and small deals below market value, where I know the day I buy it, it's worth way more than what I paid for it. That's good. I don't get that in stocks. When I pay $400 for Tesla stock, I paid $400 for Tesla stock. It's worth $400. If it goes up or down tomorrow, that's speculation. But when I can buy a house for $400,000 and know it's worth $600,000 tomorrow, that's money in my pocket. But I have to come clean. I've been tempted to invest in places like Arizona, where it looks like there's more cash flow, or Florida, or Idaho, or whatever, because of this interest in, well, there's more cash flow. But after this study, I start realizing, no. Do not break what I tell all my course members is a must-follow rule. 30-minute rule. Do not invest outside of 30 minutes from where you live. Number 2, do not speculate. Don't overpay for an apartment building just to say you got an apartment building. That's bad. Speculation is very, very painful. See, this is where if we go back to those Harvard numbers and we say, hey, you know what, for that single family equation, instead of investing $100,000, what if we only invested $70,000, but we took control of a deal that was worth $100,000? You're still so much more up on this real estate ride than you would have been paying market value for the multifamily deal. Another rule that really reinforced what I've believed for a long time is stick to really safe financing. 30-year fixed rate financing, the longest term of fixed rate financing you can get. Why bother with prepayment penalties and expensive appraisals and balloon payments on commercial loans? And stay away from overbuilt areas that got hit a lot harder with way worse vacancy rates during the recession. And don't get me wrong, I love multifamily real estate. I love apartment buildings. I love the fact that if you own a 10-unit apartment building and you raise the rent just $30 per unit, all of your monthly cash flow goes up by $300 a month. In one swoop. Like, that's cool. That's really awesome. And yeah, that kind of makes you feel like you have more scale. But the problem is we've got to separate the misconceptions like, oh, multifamily does better in a crash. No, it doesn't. From actual investing principles. Another big misconception is that somehow scale is going to get you a better deal, when in fact, it's more likely to do the opposite. See, when you start looking at scale in these bigger apartment buildings, what are you setting yourself up for competing with? Well, you're more likely to compete with these hedge funds and these Wall Street companies and these capital funds that want to dump money into real estate and they don't care how much they're paying. So you're competing against this really sophisticated audience with a lot of money to get into big multifamily deals. And I mean, by big multifamily deals, I honestly just mean anything above 5, 10, 20, 30, 50 units, like all of that stuff. It's all gonna be exposed to more sophisticated investors with more money. In other words, there's no surprise it's harder to get good deals on bigger multifamily deals because the whole scale concept, which is how funds sell you into investing with them, is really just a way for funds to park money faster and get their fees faster. Scale actually ends up hurting you because you end up with a worse deal because there's more competition, which makes sense. And that's where I usually recommend anytime you're thinking about investing in something, remember this, $10,000 is $10,000. If I put $10,000 into a condo and I make $1,000, I made 10% on my money. If I put $10,000 into a 100-unit apartment building with some investment fund and I made $1,000, I made 10%. If I put the money into Tesla, $10,000 into Tesla, and I made $1,000, it's 10%. It's all the same. Which I know that might sound like well, duh, Kevin, I mean, obviously, but wait a minute. What do most people say about real estate? Oh gosh, well, a duplex is better than a single family house because you have 2 units. It doesn't make a difference. $10,000 here or $10,000 there, how many doors the property has doesn't predict which one's going to do better. The style of management, how good of a deal you got going in, how good of an area it is, the appreciation, the cash flow, all of these things come together to give you a return. So there's no way somebody could say, oh, because this has 100 doors and a big pool, and over there are 20 single family houses, doesn't necessarily mean one is better than the others. It always comes down to the numbers. So I don't know about you, but this information is really fascinating and helps me kind of make sure I keep putting money where I know to put it. Wedge deals, safe loans, safe places. This is the stuff I've been preaching on this channel for years. I'm really surprised I found a Harvard study that found the same thing to be true. Let me know what you think. Remember, link is in the description down below, right below those courses. Check those out, and we'll see you next time.